Okay, folks, welcome to Enlightened Investor. We've got a quick take today because we're entering into a new year, and it seems to us that there's a lot of intrepidation and fear that since we didn't have a market correction last year, really of a typical 14%, we only had maybe like 5%ers. That this year could be a year, especially with the Fed tightening, that we might see some correction. And we wanted to give you some lessons from bull markets in the history. And lost decades.
That was temporary last year, right? Because the market was up, so it was just a temporary 5% down. Okay.
Wanted to clarify that. Just very small, small corrections.
Good year.
The first thing we want to show you on this quick take is that, guys, take a look at this. The history of markets, ups and downs. I guess one of the first things I see, Mike, is that there's more up years than down years.
Right.
I see that this is a very choppy, volatile asset class. This is ups and downs of the S&P 500, the largest 500 companies. So it's not the total market, but it's just one form of an asset class, right? But you can see it's how choppy it is. And one of the things that I want to share with you is that these lost decades. So let's take a look at some lessons from lost decade. And so when I first started teaching, that was in the year 2000, and to 2009 December. That was like a year where we had a decade where we actually had negative returns for overall equities. And you can see that here in this next slide where you have U.S. large cap was down over that 10 years, but many of the different types of asset classes like U.S. large cap value or small cap value, international, maybe even some emerging markets there. So one of the key takeaways, some lessons that we've learned, even though I experienced, and Mike did too, but my first 10 years of kind of investing was that it was tough, but yet it wasn't bad because I was diversified. And if you take a look at this next slide, look at this other lesson that overall that you might have seen some negative returns, but in the bottom right-hand corner of the 10-year analyzed return, it was 6%. And what does that mean over 10 years?
You almost double your money at Rule 72.
So even though
that's gross and advisory fee, but still that's a lot better than being in a market portfolio. And I think to get some perspective here, just to remind people where we were coming into this lost decade, we had the late 90s, you had the dot-com boom / bubble, which occurred then in 2000, right? And then produced this lost decade. And, they say that history doesn't repeat, but it rhymes. And you look at the current market valuation of the S&P versus a lot of these other asset classes, and it's quite similar. So I'm not saying it's going to happen again, but even if we just get a reversion to the mean, something is going to happen over time.
Right.
But I'm not saying to be tactical either. I'm just saying to be diversified.
Diversified. And I think also people see, Mike, that real estate is also kind of was up 25% last year. I mean, that's drawing forward years of valuation, and that's another.
Well, and we've had two really good runs with the market the last 2 years back to back, and if they haven't done any rebalancing, their portfolios are heavily weighted. They're taking more. Maybe they're complacent and they're taking more risks than they need to. And then the opposite stance, though, is I think people may be fearful because the market hasn't gone down, that it's due to be down. So maybe they're getting out, and we're the data shows long term, take the risk that you need and stay in.
Sure.
Not to try and time it.
So those are some good lessons, right? And some other lessons are timing the market, right? It's better, more money. What was that Peter Lynch's quote about time?
Yeah, well, more money's been lost with people preparing for a bear market than what's actually been lost in the bear market. Because if you think about it, if you get out and the markets don't go down, they go up, you've lost money, and now when you get back in, whereas if you just stay in and ride it out, you don't lose money.
So some key takeaways, diversification, rebalancing.
Focus on the risk. I mean, you really need to focus on that asset allocation and make sure it's matched to your need, ability, and willingness to assume risk, and diversify the heck out of the risk.
Yeah, and
make sure your safe is safe, right? You don't buy high yield corporate bonds and things like that, or illiquid
especially now
annuities and things like that. You want to stay investment grade with your fixed income, and with inflation possible. Obviously, right now you look at the yield curve. There's no advantage to going long right now, right? So you keep your ladder short, and let's see what the future holds.
Yep. So be vigilant, folks, in this time. Don't panic. One of the things that we talk about a lot is don't let your emotions dictate where you're investing.
Have a plan.
Have a plan. So Gosh, we just nailed them.
Perfect.
Key takeaways, all right? So, folks, thanks for watching. Have a great day. We'll see you next time.